Good evening and welcome everyone. My name is Cameron May and I want to welcome you to our evening's discussion of getting started with technical analysis. If you're circling back and joining me again after watching my market forecast, I want to welcome you back. If you're joining us for the very first time, I want to welcome you as well. I can see a number of people waiting, so I do want to thank you for giving me your time tonight. It's going to be time very well spent. We spend a half hour each Monday just trying to add a little bit of polish to our understanding of charts and charting techniques. And today, we're going to be following up on the last two discussions we've had. We've talked about using moving averages to identify potentially market and stock trends. We've talked about refining our identification of support and resistance levels. And today we're going to be talking about when do we buy stocks once we've identified trend and support and resistance. So let's just get right to it. Yeah, it looks like we already have a couple dozen people already chiming in. So great to have you people on board. Slaytonification, hello again. I apologize. I know that I wasn't able to get to one of your questions in our last discussion. It's the way it goes sometimes, right? All right. So let's switch over here to our introductory slide. First of all, some important information that we need to be aware of. Options are not suitable for all investors, as the special risks inherent to options trading may expose investors to potentially rapid and substantial losses. Spreads, straddles, and other multi-leg option strategies can entail substantial transaction costs you need to be aware of. Transaction costs are important factors and should be considered when evaluating any trade. All investing involves risks, including risk of loss. Quick review of our Greeks. Delta is a measure of an option sensitivity to changes in the price of the underlying asset. Gamma is a measure of delta sensitivity to changes in the price. Vega is a measure of an option sensitivity to changes in volatility. And theta is a measure of an option sensitivity to time decay. And finally, while this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. And no soliciting, no photography. Hello, Gary. There in California. Yeah, anyone else, if you want to chime in, let me know where it is you're watching from. That lets me know who you are. It also just gets me acquainted with where my audience is distributed, and I think that's interesting. In our last presentation, we got the East Coast and Texas covered immediately, and Cali chimed in late. Looks like we're getting California on the board immediately. All right, so let's go right to it. I'm going to bring up the Thinkorswim platform. Robert, this is your first time? All right, well, welcome, Robert. I really do think that you'll get a lot from this. Now, you may, I always try to use language and a pace that everyone can follow, but unfortunately, I can't teach everything in every 30-minute session, so I might have to refer to archives from previous discussions to bring some up to speed. If this is your first time, just know that last week we focused on identifying trends. All right, so we talked about things like what's called Dow theory, which is just looking at stock and market cycles and identifying where we were within those sorts of trends, or at least as much as we could. And we also used moving averages. And in previous weeks to that, we talked about concepts like support and resistance and the sorts of different technical techniques that can be applied to identifying price floors and price ceilings. Because with many technicians or chart analysts, they'll kind of go through a mental process. When they bring up a brand new stock or a brand new chart, maybe they're looking at the S&P, maybe they're looking at an individual security, but they're looking at a brand new chart, trying to see it through a fresh set of eyes. And whether they state it or not, many people go through a little bit of a mental checklist. First of all, which direction do things appear to be heading? A lot of technicians assume that once something's going up, unless something else comes along to change things, it should continue to rise. All right, that's the expectation. Not always a guarantee, of course. Next up, once we've identified the trend of a stock, then we might look to see, well, where are we within that trend? Because no trend just goes straight up. It'll tend to oscillate back and forth on its way, kind of a stair-stepping or a cyclical wave-like pattern as we move up or as we move down. And so even if you have an upward trend, there may be times when prices in the short term are a little bit high, and there might be times when prices have come down to lows within that trend, and maybe that might be a little bit better time to buy, or at least that's the sort of the technical view of things. All right, so once the trader has identified trend, and they've moved on to identify where we are in within that trend, highs or lows, now might come the final step. When do we buy? All right, so that's what we're tackling today. And Kenneth, hello there. Kenneth says, good evening. Good evening to you. Another California. Oh, we got California all over the place. Big Bear, SoCal, Cali. There's Maryland. I have a brother out there in Maryland. Christina's in Denver, just over the mountains, just over the hills from us. I was in Denver in, when was that? A couple of months ago to do one of our workshops. All of you have access to free workshops. I don't know if you knew that, but we travel all around the country. You can come. We'll even give you snacks just to get an education on various topics. They're great workshops. All right. So when do we buy? What might we look to for entry signals? So let's just list off some of the common entry signals that are used. And I might lean on you veterans a little bit here. If you think about maybe one of the classes that you've taken from, who knows, James Boyd or Scott Thompson, think about just one of the most basic entry signals, and I'm going to give you a hint. There's an acronym involved. And Robert, if this is your first time, now it might just be your first time in my class, but or attending one of my sessions, but this is an acronym that you hear when you're in and around the technical analysis business. You hear this rather frequently. Gary, there you go. CAHOLD or K-hold or CA-hold or however you want to pronounce it. Yeah, an acronym. It's an abbreviation. It stands for a close above the high of the low day. That's what it stands for. There's your C-A-H-O-L-D. Got it? So what does it mean? That's a bit of a mouthful. On a chart, once you've learned how to recognize it, it becomes pretty simple. It's actually very much a black and white kind of an entry signal. It's either there or it's not. And I know a lot of traders and investors like to see things in just black and white. So this is one of those. Now, black and white doesn't mean that it's a guaranteed signal. It just means that you can recognize it once you determine what you're looking for. So let's just bring up a stock. I'm just going to lean on a watch list here. And we in this class have been buying companies from the Dow Jones Industrial Average. You can buy companies for any fundamental reason that you like. I've just been using that for convenience. They're the big blue chip kind of companies that a lot of people will recognize. How about we go to our watch list and let's bring up our monitor tab. So we have 5 stocks right now. Actually, we have 4 stocks and then an options position. But how about we go a little bit further down the list so we avoid some duplication. And let's go to our charts. And we're going to kind of go through this complete process now. Trend, then support and resistance, and then finally we'll talk about potential entry signals. So starting with maybe JNJ. Okay, I could come over here and type in the symbol. Another quick navigational tip is that if you see a link right here, the little chain link, click on that and choose a color. Doesn't matter which color. Then come over to your chart and choose the same color from the link. And now when you click on a symbol in your watch list, it will automatically populate on your chart. There we go. So I'm going to go back to JNJ. All right, so I'm going to make just a quick technical argument for JNJ. Does anybody notice? Well, let's first of all look at the trend. What is the trend of Johnson & Johnson? What do you think, Gary or Kenneth, Hacky Sack, Christina? Either of you Roberts? Slatonification just because I like saying the name? Well, we could use a moving average, or we could just look at the highs and the lows. Look what this stock has been doing. It's been bouncing up and down and up and down. But essentially, would you agree with me? It appears that we've pretty much settled into a sideways behavior. Right? Relatively similar lows. Relatively, if we're looking at this period here, relatively similar highs. You also got similar behavior right back there. Christina says you could make an argument for down, right? There might be a little bit of a downward slope to this. But overall, I'm seeing kind of sideways behavior after this big drop. So let's just look at that now. If we're defining this as our trend is sideways. Next step might be to look for support and resistance. Where's the price floor and where's the price ceiling? Well, when you have something moving sideways, the price floor is just where, it just seems that most trading activity is happening above a certain level. Not a specific price like, $125.32, but actually more of a price range. I would say the area of support is kind of around here. Does that look fair? If you were to look at these two lines, does that look like a potential price support right through there? And then a price ceiling, I think we could look at anywhere from, about here to, who knows, even here. And notice I'm not trying to capture all of the price activity. Yes, prices got above this level for a few hours. They got below that level for a few hours. But generally speaking, about 95% of our price activity has happened within the range between about maybe 126 up to about 133. That's over the last several months. Okay? So that's what I see as the trend. That's where I see the support and resistance areas. So when do we buy? Well, I think your intuition would probably tell you, well, you might want to buy when we're closer to the price floors, right? Because the technical assumption is that as you get closer to the ceiling, you're just running out of room. There might not be technical profit potential there. Well, look at where we are right now. Let me zoom in a little bit closer on Johnson & Johnson. And as a matter of fact, I want to add a little bit of white space off to the right of today's candle. If you come down to this little double-headed arrow, I'm going to click on that. That's what we call our expansion settings. And if I change the right expansion settings, let me just add, let's say, 10 days or bars off to the right. Click Apply, click OK. See what I just did? Now I have that extra space off to the right, so it just makes it easier to envision what might happen next. That makes sense? Okay, so we have our trend identified. We're down close to support. When precisely might a technician buy? Well, let's go back to our acronym. K-hold stands for close above the high of the low day. So it really starts, this acronym starts with the identification of what we call the low day. And when you have a pullback, what you're really looking for is just which day stuck its little tail down the furthest. Which of the candles has the lowest low? So we would actually call today the low day because its low was lower than any previous day. All right? Now, the reason why we look for this low day is because for a technician, we typically don't look to buy as prices are falling. Instead, we're looking for some strength showing us that prices are starting to reverse. And if they keep hitting lower lows, that might just be a sign that we're just continuing downward. So each day that hits a new low, you just say, well, today's not the day. Today's now what we call a low day. Now, once you've identified a low day, and it's kind of obvious in this case, but I'm going to put an oval around it anyway. So there's our low day right there. We then look for prices to move up above the high point of that low day. So today's high was $127.30. Now I know that was exactly the high because you can actually just look right up here at the H right there. As I point at the day, it tells me right there, the H stands for high. That means that today's high was 127.30. So what we're looking for now is for tomorrow's closing price or some subsequent day's closing price to be above the high of the low day. Or in other words, we need to see the price to close above 127.30. So 127.31 would actually be adequate. Yeah, that would actually count as a close above the high of the low day. So there's the mouthful, But it's not really that difficult of a concept. Look for the lowest day, and when lows start to go higher, then look for a close above the high of that low day. So let's look for an example. Okay, let's just, in Johnson & Johnson, I did not look at this before class started. Let me zoom out here a little bit. And let's kind of look at this. Might even want to go further back, get some more examples here. But you're looking for any time you have a pullback on a stock. Let's look at this retracement right here as our example. It's pulling down. There's the low, intraday low. Next day's low was lower and lower and lower. And then finally we had this candle right here that identifies a low day. And then what happened the very next day? We had a close above the high of that low day. Now, if you're not familiar with candle construction, when you have a white candle, the top of the body is where the price, where trading ended for the day. If you have a red candle, the bottom of the body is the closing price. So here's our red candle. Closing price was somewhere right around there. The next day, the white candle, closing price was up here. So we had a close above the high of the low day, and that for a lot of technicians signals an entry. And you can see how most of the price activity for some time after that was bullish. And you can look for this again. Here's an example. I'm going to show you an example of a failed K-hold entry, just so you know that these don't always work out. Okay, here's price falling back in June. Falling and falling and falling. And we hit a low day right there. This candle during this pullback turned out to be the lowest day, and then prices started to go up. Now notice the high was right here. So we didn't immediately get a close above the high of the low day. It actually came the day after that. There's the top of the body of the white candle. That's our close above the high of the low day. And then what happened right afterward? In this case, the market had other plans, despite the apparent appearance of an entry signal. Yeah, it didn't work out. So a trader might think, well, boy, that's terrible. They might get frustrated. Well, maybe you have a rule to get out. We're going to talk about exits next week. But you might have gotten out that the next day or the day after. But if you're still on the lookout, look at this. There's another low day right there. Here's the high of that low day. And we had a close above that high right there. And if you look with what happened with price subsequent to that, in this case, it worked out. So when you're introduced to a new technique, a new tool like this, I'd always suggest just bring it up on a paper money account and take it through its paces and make sure that you're, number one, comfortable with the identification of that signal. Number two, have a plan in place for if the signal fails, okay? All right, and you can just do all of that through your paper money. All right, so let's go back. Now that we've been able to visualize that historically, and like here's another bounce entry or a close above the high of the low day, let me make one point here. A K-hold entry is also known as a bounce entry. So when you hear that term, let me come up here. There we go. Yes, C-A-H-O-L-D entry. It's known as a bounce entry because the intended interpretation there is that the prices have been falling and falling and falling, and now it appears that they are bouncing higher. Got that close above the high of the low day. However, that's not the only potential entry signal. I did want to give you a couple of others that you can be on the lookout for. Let me ask you, class, what are some other entry signals within a single day's trading that might be taken as a buy signal? I'm going to see if you can think of some. I'm going to start. There we go. I'm going to start to potentially fill that in. But we have the close above the high of the low day. There are actually a number of others that we can investigate in the coming weeks. We can't do them all today. One of the most common is just anything in the arena of candlestick patterns. Okay, what are some of the common candlestick patterns? And I'll just stick with the bullish ones for now. Hammer candles, engulfing candles, and harami candles. So how about I just quickly cover those, and then maybe we'll take a quick peek at the Dow companies and see if any of them are giving one of these signals. Oh, and exactly, Gary, there's another potential entry signal. Let me put that right here. I have to look around. I have my, if you see me peeking around like this, it's because I have a nice big commercial microphone so that you can hear me. You can't see it because it's off camera down here, but I have to, it's in the way of my screen, so sometimes you'll see me peeking around it. All right, yes, but moving average, that's what the MA stands for, crossovers. There we go. Christina, or even price patterns, right? And I'm going to just expand on that a little bit. The price pattern itself is actually a combination of support and resistance. The signal is the price pattern breakout. That's actually when you would buy, right? So that's a discussion for another time. Maybe what we could do is make this a two-part discussion where we talk about multiple types of entries, and I'll just pick up on that next week. So next week I was actually planning on talking about exits, but I'm making an executive decision right now. That's what we're going to do. Let's cover some of these others. We're going to talk about moving average crossovers and price pattern breakouts next week as additional potential entries, because actually you can flip those over and turn them into, they can present to you signals for when to exit as well. All right, but what is a hammer pattern? The hammer pattern is probably the most common candlestick entry signal, and that is when you're getting a pull down on prices, you'll look for, and I'm trying to see an example here. I think I'm going to move to a different stock. See if we can get a quick example of a hammer pattern. Actually, there's one right there on United Tech Corporation. Let me zoom in on this most recent move. So we've had a few days of selling, and then look at today's candle. Just envision that as a picture that you drew as a kid of a sledgehammer. Does that not look like a hammer? You have the hammer head and then the handle of the hammer. A few things about the traditional construction of the handle, or pardon me, of the hammer. Number one is the head should be sitting right on top of the shadow of the candle, and there shouldn't be much sticking out the top of that. That's because, you know, when you have a hammer, you don't have much wood sticking out the top of your hammer head, right? It gets in the way of the swing. And you can see that right there on United Tech. There's just very little of a wick sticking out the top of that hammer, so that's just about right. The next element is that the handle of the hammer, or in other words, the shadow of the candle, should be at least 2 times the length of the body of the hammer. Now, does this one quite meet that criteria? Maybe not quite, right? Gary, you say it's also a tweezer. Bit of a tweezer there, where you have equal lows right there. Long tails that are equal, right? Yeah, I'm not going to go too far into what a tweezer candle is, but I see what you're talking about there, Gary. But I did want to cover at least hammers, because they are probably the most common in appearance candle pattern. So why is it an entry signal? Well, here's what happened intraday. We had, in this case, a few days of selling, and then it looked like, if you can imagine, earlier in today's session, the price was all the way down here. It looked like at that time, if you were to look at the price activity on UTX, you'd be thinking, well, here we go again. Stock is just selling off even more. But then, intraday, there's a shift in investor sentiment. During today's trading, prices rallied all the way back up to our opening price and actually exceeded that. We wound up with this white candle. So that means that our closing price was up here at the top of the body of the candle. We got all the way back up almost to today's peak. So we closed on a high, literally. So you can kind of envision the intraday change in investor sentiment, and the technical assumption is wow, this might continue into the future. Now, a hammer candle, along with most candles, most technicians will wait to the next day to make sure that prices do continue before they make an entry. So that's it. Now, another big point to make with a hammer, and this is true of essentially all candle patterns, context is important. Notice I looked first for the movement just before, or the price behavior just before that hammer appearance. If you get a hammer that's not after a down move and instead it's at the top of an up move, it's not a hammer. It has an entirely different implication. So we look for hammers at the bottom of down moves. Like, for example, here's a hammer at the top of an up move. It actually has an opposite implication. We're likely to sell off. Okay, so UTX, you know, for today's discussion, we actually only have a couple of minutes left. Our 30 minutes goes really quickly. How about we add some shares of United Tech to our trading account? It's a $123 stock. 100 shares would be a $12,000 commitment. Let's just shave that in half, spend about $6,000. Let's go to our trade. Type in UTX, and on the strength of this unconfirmed, meaning prices haven't continued up the next day, this unconfirmed candle or hammer candle, we're going to buy shares of UTX. Click on the ask price. That creates a buy order for 100 shares. Let's dial that back to 50. And I'm going to submit this as a market order. Market order means I'm willing to pay whatever the opening price is tomorrow, or around that price. I don't know what that's going to be. Might be $123, might be $125, it might be $121, I don't know. But I'm going to click confirm and send. That tacks in that practice commission, and it looks like it's going to be about a $6,200 trade. Let's send that off. All right, so we've been introduced to 2 potential entry signals, but there's still a lot more that we could cover. Talked about a K-hold entry. Hacky Sack says, why only 30 minutes? It's just the way some of our sessions are. Some are 15 minutes, some are 30 minutes, some are an hour, because we just have we have an audience with a spectrum of schedule demands, so we just like to make sure that we offer something of varying lengths for a different audience. Yeah, that's it. So this class is just scheduled for 30 minutes each week. It's a quick hit. If you'd like to join me in a longer class, just so you know, I have one coming up tomorrow that's on options. If you have ever struggled with knowing, you know, boy, it's a bullish market, so do I buy a call or do I sell a put or do I do a bullish vertical spread or what do I do? That's what we talk about every Tuesday. So if you'd like to look for that, it's option strategy selection. So you can look for that in your schedule. In the meantime, though, if you'd like to hang around, James is going to be kicking off his class in about 60 seconds. So I'm going to wrap this one up, and you can pop in and listen to James. James is going to be talking about investing for a younger generation. All right. So, Kenneth, thank you. Hope you enjoyed that. We'll see how that trade goes along with the rest of ours in this class. But I'm going to set you loose. Quick reminder of your risk disclosures. Risks are real, so we want to remain aware of those. And whether I see you for tomorrow's class or tomorrow's market forecast, as many of you joined me just about an hour ago, until that moment arrives, I want to wish you the best of luck. Happy investing. Bye-bye.